What is inventory valuation? Inventory valuation is an accounting practice used to determine the value of a company's business inventories. It represents the amount of money required for production and operations, including raw materials and goods. The valuation depends on the costs incurred in acquiring inventory and producing goods. Companies perform inventory valuation at the end of each accounting year to determine the cost of goods sold, COGS, and the cost of unsold inventory. Inventory valuation involves calculating the total money associated with a company's production during a financial year. Since inventory is one of the largest current assets of a company, financial managers rely on its valuation to assess the cost of goods sold and ultimately determine profitability. Inventory valuation plays a crucial role in calculating gross profit, which is obtained by subtracting COGS from total revenue. Inventory may include both sold and unsold goods, as well as raw materials, semi-finished products, and finished goods.
Right now, Kalkine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.
The value of inventory is determined by multiplying the total number of units by their respective unit price. According to generally accepted accounting principles, GAAP, inventory must be valued at the lower of market price or cost to the company. Inventory valuation is recorded as a current asset on the balance sheet. The costs associated with inventory valuation include factory overhead, direct labor, handling, direct materials, import duties, and freight in, but do not include administrative or selling expenses. Inventory valuation is essential for several reasons. It affects the cost of goods sold since a higher ending inventory valuation leads to lower expenses recorded for COGS and vice versa, directly impacting profit levels. Incorrect valuation can cause errors in financial statements across multiple periods, as ending inventory in one year becomes the beginning inventory for the next. Lenders also consider inventory valuation when determining loan ratios, as inventory is a significant component of current assets. Additionally, tax obligations can be affected based on the cost flow method used, with the LIFO method being particularly beneficial during periods of rising prices to reduce taxable income. Different methods are used for inventory valuation. The specific identification method tracks each inventory item individually, using serial numbers, RFID tags, or stamped receipt dates. This method is typically applied to large or uniquely identifiable items. The FIFO, first in, first out, method assumes that the oldest inventory is sold first, leading to a higher ending inventory value during inflation and lower COGS, thereby increasing gross profit. However, it may not always provide the most accurate valuation. The LIFO, last in, first out, method assumes that the newest inventory is sold first, which reduces tax liabilities in times of inflation but is rarely used because older inventories may become obsolete. The weighted average cost, WAC, method calculates the cost of goods sold and inventory value by dividing the total cost of goods by the total number of units in inventory. For more related videos, please subscribe to the channel and click the bell icon to get notifications.